Hi, welcome to valuationmediation.com. My name is Melissa Gregg, and I'm a business valuation expert with over 20 years of experience. And I specialize in not only business valuations, but in also pricing companies for sale and negotiating those deals on behalf of my clients. Today, I want to talk about a way that business owners can start to take a little bit more control of this sale process, and you will stop guessing about your company's worth. You can really understand how a quick strategic valuation can save your deal. And for the most part, most of my clients get the question all the time, like, what's your company worth? What's the value of your company, especially if they are considering going to market, or even a lot of times there could be a buyer that comes knocking at the door and says, "Hey, I think I'm interested in buying you. I've been your competitor, I've been your vendor, your client for years, and I know you're profitable, I know you're successful. Maybe you're at a conference, right? And you see them." This is also for advisors who are advising clients, but more specifically for the company owner. And quite frankly, we'll kind of walk through probably some of the top 10 questions that we get asked about this process, because what we're encouraging you to do is crunch the numbers. Everybody wants to know what the value of their company is, and they're always saying, well, can't you do a quick and dirty evaluation? Can't you just, back of the envelope? Like, what's the number, Melissa? And the fact of the matter is, most business valuation experts don't really want to do that process. They want to give you a full report. They want to give you 100-page report, or something, or maybe a smaller report. We're going to talk through why really just getting the numbers or range of value is probably going to be more beneficial in the transaction than you even know. But we're going to structure it like in, a conversational kind of question and answer. So the first question that we get is, why do so many business owners skip a valuation when they're looking to sell their company? The odds are they're contacting a business broker or an investment banker, and that person is saying, "Oh, you don't need a valuation. We'll just give you a range of value. We'll determine what your minimum ask price is, and then the market will determine how much you're worth." And that's all fine and dandy. But the fact of the matter is, most of these brokers or CPAs or lawyers or even exit planning strategists can't defend those numbers when the buyers start asking really tough questions. And what we encourage is a preliminary valuation or a reality check that kind of bridges the gap. It gives you a credible number or a range, and you're not paying for a full 50-page report. The fact of the matter is, what we're doing is more similar to a buyer looking at your financials. So we're going to look at your past 5 years of financials. We're going to ask you some tough questions and really understand what happened so that you're prepared for due diligence, or when a buyer starts asking these tough questions as well. The other thing is, we're going to base the valuation on your cash flow, on the risk of your cash flow continuing, and on the market and what we understand of other market participants that are buying companies and selling companies. They're going to think differently, right? A private equity firm is going to think different than a strategic buyer. And a lot of times we're seeing our clients be approached by strategic buyers where there is more of this CEO to CEO kind of conversation, this easy negotiation. But what that does is it takes you off guard, and it makes it so that you might talk too much and give away too much at the very beginning. So maybe it's easier to start with, like, what is the difference between a preliminary valuation and a full valuation report? This reality check valuation that we do really starts to give you a range of value. And it could be like a high, like, what would you expect in your best year? Like, what do you expect if they average your historical performance? What's the cash flow analysis, right? And then what are other market transactions? Like, what are some private deals that have sold that are similar to you, that are your same size, are in your same area, or nationwide have a lot of these businesses sold in general? Are you a unicorn in this space? Whereas a full report, that's a very formal 100-page document. It could be 25 pages, 50 pages. It's designed for either going to court or for the IRS. And typically, those are designed for the IRS. So that means you're going to gift the stock to somebody, you're going to transfer it into a trust. That's more in the estate planning realm where you need that big valuation to support a tax return or a gift tax return that you are filing with the IRS. And even then, we recommend that you include it with that. We do those as well, but we're specifically talking about valuations for when you're going to market or you're considering sale in the next 1, 2, 3, 5 years. Those bigger reports could cost 10, 20, $30,000, and they're probably not necessary. Like most of the time our clients don't even read them. They just put them in the file, and if they need them to support something in the future, okay. But in most M&A deals, if you're going to buy out your partner, even if you're getting divorced, you don't need a full report. You need numbers. You need to understand the basis for those numbers. You need to understand that they are founded on good financial analysis. So that's typically not what a business broker or even a valuation software is going to do. It's just going to look at your EBITDA. It's going to run maybe 3 to 5 times EBITDA, but it's not looking specifically at your cash flow and if a buyer is going to come in and slash your cash flow, right? You need to do some of that analysis so that you can clean up your books, so that you can understand where somebody is going to look. And it gets you a little bit more prepared for the process of due diligence, which is not always a very comfortable situation. Okay. So why do I not have a full report on file during due diligence? So once you have a report, it becomes a permanent document. It goes in your files. It is a document that you know exists. So when the buyer comes in and you've selected 1, 2, or 3 buyers and they go through due diligence, which means they're going to ask for 5 years of historical tax returns. Well, we already have those because we provided them to us. If they ask for some of your internal financials, why do your internal financials not match up with your tax return? You might want to know that. Why did 1 year your gross profit grossly decline or increase? You might want to know that. But in due diligence, they're going to ask for all prior valuations. And now you want to be able to truthfully respond by saying, we don't have any valuation reports. We've just worked with consultants and understand what we are worth, and we're willing to negotiate. But if you have that report and you say, well, yeah, we have a report, but we're not going to give it to you, or you lie and say you don't have it, it sets you up and your credibility to be at question at the very beginning. Because again, somebody asks you for the information and you're like, oh, yeah, we have it, but I'm not going to give it to you. Is that the type of person that you want to go into a deal with? That buyer may be waving a red flag anytime that they hear something like that. So this allows you to keep that information very confidential. Sometimes we will release like a summary that's based on the market, which could give you a low range, a high range, and then somewhere in the middle where we're really telling you what would be reasonable, what would be fair market value. Your business broker or your M&A advisor should be reaching for strategic value. They should be reaching for getting you a higher price based on running an auction style process, which is getting a bunch of buyers together at the same time. What we notice though is that a lot of times these buyers, especially in the current environment, are coming to you out of the blue. And it's almost like maybe it's a year or 2 or 3 too soon. But when you have a buyer in hand, it's best to at least negotiate a little bit so you save face, so you preserve that relationship, and so that you understand what their perspective of value is, right? They might come in and you're worth 5 million and they offer you 3, you know off the bat that that's not a reasonable number. As opposed to they offer you 3 and then you have to go work with a business valuation expert for 6, 12 weeks to understand if that 3 million is reasonable. By the time you have the valuation prepared, that buyer's in the wind. They're gone. They're not interested because you didn't even know the value of your company. They're expecting you to know that. Now, they're also expecting you to tell them that number. And we might talk about that later, but don't give them a number. Allow your consultants to negotiate on your behalf. Allow them to get a non disclosure before you start releasing information. Okay. So, who benefits from this preliminary valuation? If you're an owner of a business and you're preparing to sell in 1 year, in 3 years, in 5 years, and quite frankly, we're recommending that people actually create businesses right now to sell in the future. So, if you're even planning to maybe buy out a partner, if you're planning on maybe allowing some key employees or investors to take a greater share of the business, doing this strategic planning on a yearly basis not only sets a benchmark for like the value now, but then each year you really have targets that you're working towards. And this is where we bring in your financial advisors or your exit planners or any of these people that are helping you plan for the future. It could even be your CPA. Like, how do you start to eliminate some of the personal expenses that you're running through the business? Even if they're discretionary, right? How do you start to clean up your books and clean up your situation so that when the buyers start looking at these things in due diligence, you're prepared. You already have a database and a war room ready so that you can exchange those documents very quickly. You're already looking at your financials on a trailing 12-month basis because, quite frankly, buyers are buying the recent past. They're not buying the future. So if you're running DCF models or future planning, that's great, but that's not what a buyer's paying for. They're going to look at your past and base it on your past, which means that they could underbid you if you don't have a strong like perspective that's been going up. You don't want to wait until everything's declining to sell. You're not going to make as much money in that kind of situation. So if you want to have a reality check, most buyers or most business owners actually think their business is worth way more than it may be worth. And so just to have that base of understanding, to have that knowledge, and when somebody does talk to you, you might be like, "Yeah, I'd be willing to sell my company for like 10 to 15 million." And they'd be like, well, hold on. How do you know that? Oh, we work with advisors every year to understand the value. I don't know. It could be more because we keep in on increasing our revenues or our profitability. So it would be better for you to be able to have that discussion with them and then shift them to your negotiation team. Okay. So, how does this protect you when you're negotiating with sophisticated buyers? The odds are, if a buyer comes to you and asks you if you're willing to sell your company, they're probably a little bit more sophisticated than you think. Even if they've bought one other company in the past, they've learned a lot of lessons. And if you're being approached by private equity or strategic buyers like investors and things like that, they probably know more about how to negotiate a business deal. They know all the ins and outs of the structure. They know whether they want to do a stock deal or an asset deal. And for the most part, it's usually an asset deal. But again, you may not know some of these things. And so when you're going through the valuation process with us, we're strategically helping you prepare to know how to have these conversations when they come out of the blue, when you're at a conference and you're having dinner at a nice place with a bunch of CEOs and they start talking about these things, you will be very prepared to keep up with the conversation. The thing is, if somebody comes and they're a sophisticated buyer, they're going to try to anchor you in a low value. They're going to try to talk about earnouts or maybe seller financing or deferred payments into the future. Again, none of those things are really what you want to do. everything that happens and is paid to you at the closing table is all you're going to be guaranteed. Any sort of earnout or future payment, you're going to have to fight because now you don't own the company, you have no leverage. And if you want to fight that fight, you're going to have to sue them. Even the earnouts, we would suggest be structured based on revenue or gross profit, which is a lot easier to determine as opposed to EBITDA or net income or profit before taxes. All of those metrics are very discretionary and can be manipulated by the buyer in the future, which means you're going to court to fight this. And that's not really what you should be interested in. This also means that you have an independent data-based number that we then kind of help you create into a pitch book or the summaries that you're providing to the buyer. You don't want to give them your actual tax returns. You want to give them information in a very calculated way. You want to give them maybe some simple information, but not everything all at first. You want to know what their price is for your company before you give them everything. And you want to determine which buyer you want to move forward with. Okay. So let's see. Why shouldn't I rely on a broker's opinion of value? Here's the thing is a broker could give you a perfectly good number, and there are a ton of business brokers and investment bankers that actually have a valuation credential. But the thing about us is I've been valuing businesses for 20 years and usually 50 to 100 businesses a year. And so I see a lot of different companies in the same industry, and I can tell you the comparison. I also structure and negotiate a ton of deals, and so I can tell you what the buyer's looking for. And again, brokers have that same capacity. They know the market. They may specifically specialize in your type of business. You know, there are a lot of brokers that deal with dental practices or restaurants or franchises, but these brokers are typically paid on commission. And so they're going to offer you this broker opinion of value, maybe for pennies on the dollar, but they want to sell you. So it's in their best interest to set a purchase price that they believe they can attain, or maybe even lower than what's reasonable so that they can make a greater commission on the higher price that they achieve for you. And quite frankly, their valuation could be either deflated or inflated to secure that listing, right? They want to get your business. We don't take commissions. We don't care if you do the deal. We actually are there to advise you throughout the process and to negotiate hard on your behalf so that you get an ideal price. But at the end of the day, we get paid for the valuation up front, and then we earn a retainer every single month to help you move along in the process, right? And so we care that you do the deal that is right for you. And at all times, if we see red flags, we're going to bring it to your attention. A lot of times, even when we're negotiating that purchase price, we're recording our conversations and allowing you to listen to what the buyer was saying. Sometimes that could be a deal breaker. If they plan on taking your business and just destroying it, or you hear things that you don't like, the value of the deal is not always on price. And this is a hard lesson to learn, that it's about the people, it's about the partnership, it's about the legacy of your business moving forward. And so that's going to be important things, not just establishing if you can get it for the highest price possible, or lowballing people so that they can get a greater commission on that premium price that they get for you. Okay, so what happens if you overestimate what your business is worth? You could waste a lot of times where you are chasing a number that the buyers are just thinking is unrealistic. And we've had buyers that do this. And even when we tell them, or we have businesses that do this, and even when we tell them that the price is too high, they don't care. That's what they want for their business. So if that's what you want, you may be waiting for a little bit longer to do the deal, and that might be perfectly fine. You can be upfront that you are for sale, but for the right price. You might even, I have businesses that are very transparent with their employees, right? So this is kind of a situation that if you overestimate your price and you have somebody come in and they price and they give you an LOI or a letter of intent based on inflated cash flow numbers, the deal could collapse. And due diligence is when the numbers are going to be apparent that they don't match reality. So you had adjusted numbers that showed that your cash flow was $1 million, but your tax returns show $100,000. That's going to be an issue, right? You need to understand that your numbers and your price need to match reality, because these buyers will come in and they might do a quality of earnings. They might take a hard look at your receivables, at your inventory, at your turns of revenue, right? They're going to look at your clients and your customers, your vendors. And if you're not being realistic about how you're earning money and how you're portraying it in the early stages, they're going to come and do a retrade. And a retrade is when they're a month out from the deal and they say, you know what, we've gone through due diligence and we don't think that this business is worth what we said we would buy it for in the LOI. We want $1 million haircut. Now you're so invested in the process that, and your broker or your investment banker is also invested in the process because they make their money at the end. They get a commission based on this deal closing. So now everybody wants it to finalize. Even you got excited about this deal closing, but are you willing to still do the same deal for $1 million less? Because have we even talked about taxes yet? But anyway, let's not talk about that. Buyers are basing their offer on cash flow, not potential cash flow in the future, not emotional, you need $5 million to pad your retirement. They're going to look at your trailing 12 months of performance, maybe your trailing 24 months, and they're going to make a decision based on that. And so if in the deal, that 6 months, that 12 months that you're doing the deal, your numbers start to go down, best believe they're going to come in and negotiate again and renegotiate this position. And they know that you're highly invested at this point. They know you will probably take that offer. So you need to be prepared for that and don't overvalue it from the beginning. Okay. So how can I keep my valuation current? These valuations typically need to be updated annually. Now, that doesn't mean that you have to wait till December to do it. Actually, sometimes we recommend you even do it in the summer. Your accountant isn't as stressed, your advisors aren't as stressed. You can get a valuation as of like a June time period. But if you want to do that on an annual basis, it's going to be simple, it's going to be cost effective, it's going to be an easy way to track your performance over time. It also allows you to understand how your value is changing and why the value is based on what cash flow, right? It gets you really knowledgeable about your financials because we're asking you questions each time. We're working with a team of advisors that you've picked so that they know the valuation, and then you determine what you're going to do to increase that valuation. It's kind of like a financial checkup, if you will, for your business. And it also allows you that at any time, if you want to do some of those strategies like sell to your employees, or you now want to pull in a CEO or a CFO, you have the capability to allow them to buy in at stock or even offer them like a profits interest, which is based on the value or your profits, but is not actually equity. So we can talk through some of those things if you're working with somebody who understands the value of those things and what it is for the future. Okay, few more questions. So how long does a preliminary valuation take and what's the cost? Great question. So typically we're looking at preliminary valuations to be somewhere between $5,000 and $7,000. So if you need it really quick, obviously it could get up to 10,000. If it's a simple thing or you're just looking at maybe potentially purchasing another business and you just want a sanity check, maybe we could go as low as 3,000. We have preferred business brokers that we work with and lawyers around the country. And if you work with them, usually they can get a little bit better pricing. Or if you have multiple businesses, like you have 3 businesses, but one's a real estate holding, we might be able to give you a deal. But for the most part, we're just doing the analysis, and that's a very reasonable price because, again, most people are charging 10, 20, $30,000 for one valuation. Now, those people could take 3 months to do the valuation. We're usually doing it in 30 days. And this is going to be an oral presentation of those numbers. Have we done those in a week? Yeah, we're pretty efficient and we know the market. We know the data. We still got to look at your 5 years of financials. We still got to input that because we need to know what the buyer's going to see, right? We need to know what sort of skeletons are in the closet. We need to pull them out, dress them up, and make sure we address those issues with the buyers at the beginning so that they don't find them afterwards. But usually we're doing an oral presentation over Zoom, which means we operate and work with companies around the country. And sometimes we'll give like a summary schedule. It might be a market approach. It might give you some range of value so that in the future, if somebody had it, it would be like, well, the business was between 8 million and 15 million, but you're going to know that we're really at 10.5, right? You're going to know what the real numbers are, but I also want you to see how much is a buyer going to push your number down and how much could you make if you kept your highest, most profitable year going forward for 2 or 3 years, right? So this is what we typically see as a very strategic way of looking at value. And again, if somebody comes and knocks on the door and says, "Hey, what are you worth?" You need to respond quickly, sometimes within a week, sometimes definitely within 30 days. So give us a call, talk to us, we do consults and you can meet with us and talk about your situation. But those are some of the basics. We really want you to be prepared for negotiation. And anytime we put something in writing, there could be an additional cost. But for the most part, we'd prefer to put them in writing in schedules that the buyer could use and you can use to provide to the buyer as you negotiate. Okay, final question. What should business owners ask themselves right now? So you should be asking yourself, do you know what your business would sell for today? Not just what you think it's worth. Have you been asking some of the people around you, your CPA, your lawyer, your financial advisor, your exit planner, your strategist, maybe you have a business consultant? Have you been asking them what the value of the company is, but they can't quite put it in writing and they can't enunciate why they think that the business is worth that? That's going to be an important piece that you might want to consider working with somebody. When I give out numbers, it is with authority, it is with experience. And typically it's because I'm working for buyers and sellers around the country, probably in your same industry. But if a buyer made an offer, you want to be able to respond and defend your number because guess what? In some deals, when we have a close related party coming in to buy this company, we might have to give them a number. We might have to say, listen, the range is between 10 and 12 million, and knowing that 10 million is actually our number, right? So those are the types of things. And if you're relying upon a business broker or an investment banker to just give you kind of a range of value, they're looking at what they can go and sell you for, but they're also, it's not an exact science. And so what you're going to hear from them is the market's going to tell you what the value is. You know, we're going to conduct an auction style process. We're going to contact tons of buyers and we're going to bring them and they're going to bid on your business. That's just not where we're seeing the lower middle market really finding transactions. Where if you are a business that is doing between 10 and $50 million in revenue, the odds are somebody is going to approach you and want to buy you faster than you are going to want to exit. For the most part, we see business owners in this space never really wanting to retire, right? And so you're not thinking about it until it's almost too late. Either you have a health concern or you see the business start to decline, or the industry just changes, right? You lose a big client, you get tariffs, you get higher costs, and you just don't want the risk anymore. Maybe you don't want to get any bank debt. We understand that. If you want to grow faster, you might have to change things. It might not be of interest. So, this is where we see most people coming for a reality check kind of valuation. And we really see advisors able to capitalize on this and offer a premium service for their clients if they recommend that their business value or their business clients get a valuation. So, in the long and short of it, you don't need a 100-page report to know the value of the business. You need a clear number that you can defend in the negotiations. And a preliminary valuation or a reality check valuation gives you just that. So if you're planning to sell, if you're thinking about buying out your partner, or you just want leverage at the table in case somebody contacts you at that next conference, start with one of our valuations and then consider doing it every single year. It's very cost effective. You'll always know your number and you'll be prepared for anything that comes down the pipeline. And you're not getting it from somebody who has a vested interest in you actually selling your business. We want you to sell when the timing is right and when the buyers bring the best offers. And until then, you should know exactly what the price of your company is so that you can have reasonable discussions with anybody at any time. Reach out to Valuation Mediation to set up a consult and meet with us to discuss your specific issue. It's a complimentary meeting. Bring your advisor, bring your CPA, bring the lawyer, bring whoever is helping you make some of these decisions. If it's the next generation, all of these things we can discuss what the right process is for you and then move forward in a very transparent, clear, economical way.